Hi, everybody. Welcome to Be Different for Success. Today, we'll be talking about common mistakes in stock trading. Nobody's perfect. We are all going to have our wins and losses. However, some of the mistakes you might make when trading stocks are actually pretty common, and by no means are reserved for you alone. The majority of investors make many of the following mistakes. In fact, in some cases, the investor may continue to make the exact same mistake many times over when they don't learn from their previous errors. Perhaps you have some direct experience with such situations. The good news is that most of these mistakes can be simply avoided through awareness. We will take a look at the most common mistakes here and identify ways in which to eliminate these trading errors. Number 1. Buying shares in a business which you do not understand. Too often, investors gravitate towards the latest hot or fancy-sounding industry. They may know very little or even nothing about technology, biotech, or the specific industry in which the underlying company is engaged. Of course, that does not stop them from trying to jump on what they expect to be the next profitable train. In this scenario, the investor is overlooking all the advantages and benefits they would have over investors who know little about the industry itself. When you understand a business, you naturally have an advantage over most other investors. For example, if you run a restaurant, you'll be in tune with businesses involved with restaurant franchising. You will also see firsthand, and before they become public knowledge, the habits of the patrons. By extension, you will know if the industry is booming, getting slower, or cooling down, well before the vast majority of investors. To take our scenario a step further, by seeing the trends in the industry in which you are engaged, you should be able to spot some opportunities to make great investment decisions. First-hand knowledge can mean investment profits. Number 2. Expecting too much from the stock. This is especially true when dealing with penny stocks. Most people treat low-priced stocks like lottery tickets and anticipate that they can turn their $500 or $2,000 into a small fortune. Of course, this can sometimes be true, but it is not an appropriate mindset to have when you're getting into investing. You need to be realistic about your expectations from the performance of the shares, even if such numbers are much more boring and mundane than the pie-in-the-sky levels for which you are hoping. Look at the performance of the stock up until this point. Based on the previous performance, while not indicative of what may be to come, you could get an idea of the volatility and trading activity of the underlying shares. Typically, a stock will continue to act mainly as it has in the past, and usually that will be in line with the overall industry. Number 3. Using money you cannot afford to risk. You would be blown away if you could see how different your trading style becomes when you are using money which you cannot afford to risk. Your emotions get heightened, your stress level goes through the roof, and you make buy and sell decisions which you otherwise would have never made. You should never put yourself into the high-pressure situation where you are putting money on the line which you need for other reasons. The first thought is to only invest in speculative shares with risk money. However, we can take it a step further and suggest that you do not even use real money when you are getting started. Consider paper trading, which is no risk and requires no money whatsoever. Then once you get good at paper trading, you can migrate towards trading real cash. When you invest with money that you can afford to risk, you will make much more relaxed trading decisions. Generally, you will have much more success with your trades, which will not be driven by negative emotions or fear. Number 4. Being driven by impatience. We may have touched on the different emotions you can have when you're investing, but one of the most costly ones is impatience. Remember that stocks are shares in a particular business. Businesses operate much more slowly than most of us would like to see, or even than most of us would expect. When management comes up with a new strategy, it may take months, if not several years, for that new approach to start playing out. Too often, investors will buy shares of the stock and then immediately expect the shares to act in their best interest. This completely ignores the much more realistic timeline under which companies operate. In general, stocks will take much longer to make the moves that you are hoping for or anticipating. When people first get involved with shares of the company, they must not let impatience get the best of them. or their wallet. Number 5. Learning about stock investments from the wrong places. This is an extremely important point. There is no shortage of so-called experts who are willing to tell you their opinions while presenting them as well-educated, well-informed, knowledgeable, and endlessly correct. One of the most significant parts to investing well is to identify and isolate sources of guidance which consistently help you achieve profits. For every good piece of information which may be of benefit, you will probably see hundreds of pieces of really horrible guidance. Always remember that just because someone is being featured or interviewed by top media does not mean they know what they are talking about. And indeed, even if they do have a stellar grasp of their topic, that still does not mean that they will be right. Thus, your job as an investor is to assess which sources of information should be trusted and have demonstrated a reliable and ongoing trend of wisdom. Once you have identified those individuals or services which may lead to profits, you should still only partially rely on their thoughts. Ultimately, you should combine them with your own due diligence and your own opinions to construct your trading decisions. Number 6. Following the crowd. In many cases, the majority of people only hear about an investment when it has already performed well. If certain types of stocks double or triple in price, the mainstream media tends to cover that more and telling everyone about how hot the shares have been. Unfortunately, by the time that the media tends to get involved with a story about shares rising, it is usually after the stock has reached its peak. The investment is overvalued by this point, and the media coverage comes late to the game. Regardless, the television, newspaper, internet, and radio coverage pushes the stocks even higher into the excessively overvalued territory. Number 7. Averaging down. Averaging down is typically used by investors who have made a mistake already, and they need to mitigate their error. For example, if they bought the stock at $3.50 and it drops to $1.75, they can make that mistake look a little bit less awful by purchasing a whole bunch more shares at this new lower price. The result is that now they've bought stock at $3.50 and more at $1.75, so their average price per share is much lower. This makes their loss on the stock appear far smaller. However, what is really happening is that the individual bought a stock which dropped in value, and now they are sinking even more money into this losing trade. This is why some analysts suggest that averaging down is just throwing good money after bad. Averaging down is typically used as a crutch to help investors cover the mistake they have already made. A more effective strategy is to average up, where you purchase more of a stock once it starts to move in the direction you are anticipating. The share price activity is confirming that you made a good call. Final thoughts. Ideally, you will not be committing too many of these common errors. However, the fact of the matter is that the majority of investors, in most cases, will continually fall back to making some of the mistakes which we've discussed in the article above. Luckily, you can use your losses and mistakes to learn how to avoid them next time. In fact, most people learn more from their losses than they do from their gains. Given enough time and a sufficient number of bad trades, you will be in a much superior and more profitable situation. Ideally, you will phase out the common mistakes early enough that you're able to retain a big part of your portfolio. Then, with your newfound enhanced wisdom, you should be able to start gathering some profits. Thanks for watching this video. I hope you liked it. Please click the thumbs up and write your personal tips in the comments below. Thank you for your support, and don't forget to subscribe to the channel if you want to hear more from us. See you in the next video.